When you look at the 1-minute chart for Dogecoin, you will often see the price hit an invisible floor and bounce back up. In trading, we call this a support level. Most traders treat this floor like a safety net. They place automatic sell orders, called stop losses, just below the line. These are designed to trigger instantly if the price falls, selling the asset to prevent a total loss. The conventional wisdom is that if this floor breaks, the asset is in trouble. When the price dips below that line, it's usually seen as a signal to get out as fast as possible. But an obvious breakout is often just a lure. The safety net everyone sees is actually a setup for a much larger play. Selling the moment a level breaks feels like the safe move. But when thousands of traders do the exact same thing at the exact same time, they become the targets of the very market they are trying to navigate. Large institutional players, or whales, have a problem that retail traders don't. Because they deal in massive amounts of Dogecoin, they can't just buy it all at once without moving the market. If a whale tries to buy millions of dollars of Doge in a quiet market, every coin they purchase pushes the price a little higher. By the time they finish the order, they force themselves to pay a much higher price than they intended, a friction known as slippage. To avoid this, whales look for areas where thousands of small sell orders are sitting in one place. Your protective stop losses are the exact supply needed to fill their massive buy orders without driving the price up. The whale intentionally puts short-term downward pressure on the market, nudging the price just far enough to reach those stop-loss clusters. This breakdown isn't a natural market shift. It is a highly engineered move, designed to manufacture the liquidity the whale needs to buy in bulk. The moment the whale's pressure pushes the price below the floor, the trap is triggered. Thousands of stop losses go off at once. These are forced sell orders, and as they hit the market, they create a chain reaction of selling. This causes a violent downward spike in the price and a massive surge in the amount of Dogecoin being traded. This predatory move is a formal market strategy known as stop hunting. While retail traders are selling in a panic, the whales are on the other side of those trades. They are systematically buying up every single one of those coins at a discount. The price almost immediately recovers in a sharp V-shape. The sudden recovery proves that the breakdown wasn't a change in trend. It was a forced extraction of assets from small traders. On a fast-paced chart, it's difficult to tell a real breakdown from a manufactured one. You need a way to see what's happening beneath the surface in real time. Instead of just watching the price, we have to measure the underlying momentum, the actual speed and force of the money moving the asset. We are looking for a specific anomaly called divergence. This is when the price of Doge moves in one direction while the underlying momentum moves in the exact opposite direction. Identifying this momentum shift allows you to see the manipulation as it happens, giving you a chance to react before the price reverses. The tool we use for this is the volume-weighted RSI. A standard RSI acts like a speedometer for the market, but incorporating volume shows us the actual force behind the movement. It helps distinguish between a few small traders panic selling and a massive whale moving in. Here is the signature of the move. On the top chart, the Dogecoin price drops to a new lower low, which looks like a breakdown. But at the same time, the volume-weighted RSI below it is actually rising, creating a higher low. Even though the price is falling, the upward momentum is increasing. When you see a massive spike in volume during this mismatch, it confirms that large buyers have stepped in to absorb the supply. This clear three-part signal, falling price, rising momentum, and huge volume, reveals the specific, undeniable footprint of massive institutional buying. Because these moves happen so fast, traders use this information for a strategy called scalping, entering and exiting trades on the 1-minute time frame for quick gains. You enter a buy order the moment that RSI divergence is confirmed by the volume spike. This allows you to step into the trade right alongside the whale. To manage your risk, you place a tight stop loss just below the bottom of the price spike. If the manipulation continues deeper, you're out with a small loss. But if the V-shape recovery happens, you're positioned for a fast profit. Understanding this data changes your position in the market. You are no longer the one being hunted. You are the one profiting from the whale's maneuver.